We have looked at both revenue and expense behaviors in isolation. We will expand to a more realistic transaction flow. Let's look at an example of a retail business where the company purchases goods and resell them to customers. We'll look at how inventory, cost of goods sold, sales, and cash receipt impact the financial statements. The company has been established with $100,000 cash provided by shareholders as initial paid-in capital. The company has agreed with the supplier to supply goods for cash and it is ready to purchase goods for sale. There are 4 types of inventories: retail inventories, raw materials, work in progress, and finished goods. When a company purchases goods for resale without any further machining or processing to add values, the inventory is classified as retail inventory. Rest of the inventories are booked by the company that manufactures the finished goods as opposed to purchasing what it sells. Raw materials are the inputs from which products are manufactured, such as iron ore for steel manufacturing company. Work in process is anything in between raw material and finished goods. They are partially finished goods that require further processing. Finished goods are goods that have completed the manufacturing process but not yet been sold. In this example, we focus on retail inventory. When companies purchase inventory by cash, cash is reduced and the same amount is booked as inventory. Debit inventory, credit cash. There is no income statement impact. The debit side and the credit side of BS remain unchanged as only the components of assets changed. When the company sells the inventory, it is expensed as cost of goods sold. Inventory sold moves to income statement and becomes cost of goods sold. Debit cost of goods sold, credit inventory. Debit corresponds to booking expense, and credit corresponds to reducing inventory. BS and income statement combined, the debit side and the credit side are equal. When inventory is sold, revenue is booked simultaneously. Let's assume they were sold for $75,000 cash. $75,000 cash is booked as revenue is made. Debit cash $75,000, credit revenue $75,000. Obviously, companies always sell their inventory above their cost, otherwise it loses money. As a result, its net income is $25,000 for the transaction. As we have seen in the past videos, the same amount of retained earnings increase, linking the income statement and BS. At the end of the transactions, the company made $25,000 income, and the balance sheet looks like this.